All right. So on advanced investment appraisal, which I know we are familiar with most of these things, and at this level, the expectation is that the normal investment appraiser, right, which is coming. Okay, so let me start here. All right. So the normal investment appraiser, is the normal way we normally have it, right? Which is this what you can see on my screen, right? This is the one we are all used to, and where we are told to get the value of the net present value of an investment and see if it is if it's positive, then we say okay, go ahead with the project. If it's negative, we say oh, this project is not visible because of what of the future cash flows are not matching up the obligations. So we normally this is usually the flow and this is usually the template where we have the income, we have the expense, we have the tax allowable depreciation, we have taxable cash flow, we have tax, we add back tax allowable depreciation, and we go to the non-operating cash flow where we have the initial outlay, which is the investment, or the investment we at the initial stage. Also, working capital, then realizable value, if at all there's going to be a realizable value for the asset, which mostly is usually plant and machinery. And next, we have net cash flow. And we subject it to our discounting factor techniques, which we have, as you can see on the screen. So this is the normal pro forma discounted cash flow approach that we know. But now we are now moving further. At this level, we are looking at what? We are looking at foreign projects. So foreign projects too still takes this flow, but there's just a twist about it because why? There are more than what one country is involved. So there are going to be issues of exchange rate and political barriers, tax treaties, and so on and so forth. So we are going to explore that today, and we are going to solve a question to to consolidate that. So this is how the foreign project um, template looks like. I don't know if you've seen this before or you have this with you. So this is how the template looks like, where you have the operating cash flow as you have it in the local project. You have your income, you have your sales and others. Please, can everybody hear me clearly?
Yes, we can.
All right, thank you. So where you have your income, your sales, and others, you have your expenses, right? Your cost of sales, your expenses will include cost of sales, which is the variable cost, the fixed cost, as you know it, the management license fee. So in a foreign operation, there's usually what management license fee. So let's say, for instance, now you want to for instance, now I'm in Nigeria now, and maybe I can get raw material easily in China, and maybe China's taxation is low. Maybe China has some favorable conditions for me that if I invest in China, it will be cheaper for me than if I invest in Nigeria, right? So if I'm going to invest in China, there are some fees I might need to pay, which involves what license fee, right, to operate in China. So in a foreign operation pro forma template, we usually have what management license fee. We also have royalties. Also, royalties usually are also paid. So those are the hard zone in foreign projects. Also, tax allowable depreciation. We have after the tax allowable depreciation, you have your taxable cash flow, right? As you have it in the previous local pro forma template. We also have our tax. Tax will usually be at the country you are investing in. Please note that the one up here, this tax you are seeing, is usually the one at the what at the country you are investing in. So if it's China, it's China tax that is going to be there. Then after that, you add back what your tax allowable depreciation, because why? It's a non-cash item, so it's not there's no cash flow in it's not there's no flow of cash, so you add it back to arrive at the cash flow. Then you have your initial outlay, you also have your realizable value, you have your working capital, you have your net free cash flow, and you now have what? But the twist here now is, normally in the local project, at the net cash flow, we usually stop and we discount it, right, to present value. But here, because why? I operated in China, right? I invested in China. It is expected why that I'm going to remit those funds to what? To Nigeria. So if I'm remitting those funds to Nigeria, then there's going to be what exchange rate conversation in it. Exchange rate means that in China, China is yen, right? I'm going to convert yen to what? To naira. So if I'm converting yen to naira, I must convert it to my what? To my local currency. So for exchange rate, we have to get the exchange rates that we're going to convert back to our local currency. And two ways in which you can get your exchange rate is using what? The PPP model or the IRP model. And what is the PPP model? The PPP model is what? Is purchasing power parity model, and the IRP is what? Interest rate parity model. So please note that we are going to be using that as we solve questions. So after converting, we now get the what? The remitted amount. The remitted amount is in what? The local what? Local currency, which in this case, as the example I've given, yen to naira. So the local currency is what? Is naira. Now, we now have we can have situation whereby the two countries they have tax treaty. When I say tax treaty, it means that, let's say for instance now, it will be painful if I operate in China, I pay tax in China, and I come to Nigeria again and I pay tax in Nigeria. Those things can be painful. But in a situation where there's a tax treaty between two countries, let's say for instance Nigeria and China, and let's say for instance now, China's tax is 20%, right? And Nigeria tax is 25%. It is possible that if we have a tax treaty, I will pay China 20%, but when I'm paying Nigeria, I will not pay Nigeria 25%. I will only pay Nigeria what? The difference, which is 5%, when a tax treaty what exists. But when a tax treaty does not exist, then that's going to be very serious. You're going to pay China 20, you're going to pay Nigeria 25. Is that clear, please? I would like us to respond so that I know that you're following me. So I know, because I don't know who is hearing me anymore at this point. I'm sharing my screen at the moment. Is
It's
that clear,
clear.
please? Yeah, thank you very much. So we have additional tax on the foreign on the cash flow taxable profit. Then we now have post-tax income, which is what? Management license fee, royalties. What does this mean? See, if you go up, when if at the before we get to the local currency part, the foreign part, which is up, you notice that there's a management license fee. And you see down, we have a post-tax income management license fee. What does this indicate to you? It means that, for instance now, if we have a subsidiary operating in China, right? It will be like a standalone company, because why? It will be a separate entity other than us, right? Normal group and subsidiary relationship, right? They will be a standalone in China, right? Meaning that they'll be subject to China's rules and China's legal conditions. So, what does that tell us? It means that if that country wants to operate in China, it's going to get management license from us, because we own the franchise, right? Though it's part of our subsidiary, we are the group company from Nigeria. But for the fact that is operating in China, is a separate entity, is going to be getting license approval from us. So that license approval is going to be charged what? With at a cost, which is license fee. So to us in Nigeria, we are going to be giving the person what? We are going to be giving the person the license cost. It will be a fee to the person in the foreign operation. It will be like an income to us in Nigeria. So that's why you have it as a cost at the foreign operation and as an income in the what? In the home country, which is the local, under the local currency. So we have post-tax income, which is management and license fee, and what? And royalties. Also, we have post-tax opportunity cost, loss contributions. So there are sometimes when we talk about loss contribution. So for instance now, I might have a space in Nigeria. We might have a space in Nigeria where we can actually produce those products, right? But taking it to China, it means that we are going to start a new business operation, get new premises, and the likes, gadgets, plant and machineries, and what have you. It means that if we are moving that business to China, it means that the Nigeria space is going to be redundant, right? That space that is going to be redundant is going to be at a cost, because why? We might actually still be paying rent in Nigeria. We might still be carrying on overhead costs. That's an extra cost. So those are what we call lost contributions. You can note that. So after all this, we are now going to have what? An overhead net cash flow. When we have an overall net cash flow, we are now going to subject it to the what? To the project work, right? As we all know it, and we get what? The net what? Cash flow, which is the one highlighted in bold as you have it down. So this is a template for a foreign project, and is for at this level. is usually no more than this. So I don't know if you have this or you've seen this before, but I'm going to be sharing these slides to you at the end of the class. So there's no worries, right? You have it and you work with it. So any foreign project you have, just use this template, you are good to go. Let's move on. So, but before we move on, right, to solve a question, there are some things we need to iron out. I told you that in getting the exchange rate, you can we have two ways of doing it, which is the PPP and the IRP. So for us to understand that, we need to go through this to have a view of what PPP and IRP looks like. So now let's move on. Spot exchange rates. Spot exchange rate means that what the market exchange rate for buying and selling the currencies for immediate delivery. When we talk about spot means now. What is the exchange rate now? If I go to the market now, what is dollar trading for? Dollar currently is trading around 1439 or 1440, right? It means that if I go to the market, if I go to the abokis, if I go to the bank, what is dollar trading now? That is what we call what spot rates. And I know that Emmanuel would have um I've explained the other variants, which is what forward and what and futures, right? But when we talk about spot means what currency what for immediate what delivery. What is now forward exchange rate? Forward exchange rate means that the exchange rate for buying or selling the currency at a what at a specific date in the future. And if you agree with me, we usually see forward what as over the counter, right? Over the counter. When we say over the counter, what do we mean? It means nami na you. And when we say nami na you, what am I trying to say? It's not official. It is not traded on a right exchange, as opposed to what futures, right? I know you are very good on treasury management now, so I know that all this thing I'm saying, you've gone past this. So now let's move on. When we talk about four-way equivalence model, the main models for forecasting future exchange rates focus on inflation rate differences or what interest rate differences, right? So one of the ways people use in forecasting exchange rates, that's even what is currently being done right now at the moment. So those exchange rates that we see, right? How exchange rate changes, how exchange rate is being calculated, is done on what is based on what on inflation rate differences or interest rates. And we have it that the relationship between this macroeconomic variable can be summarized what in the four-way what equivalence model shown below. So we have this model, right, which explains what how exchange rate is being forecasted, right? Now, if you notice, on the first place, we on the first column, we have differences in exchange rates, we have the Fisher effect, and we have the expected differences in inflation rates. When we talk about interest rates, when we talk about parity, purchasing power parity uses inflation rate to forecast exchange rates. I come again. Purchasing power parity uses what? Inflation rate to forecast what? To forecast exchange rate. Why interest rate parity uses interest rate to forecast what? To forecast exchange rates in the future. Let me stop at that. We'll move on. Now, let's move to purchasing power parity. When we talk about purchasing power parity, what are we saying? We have two types of purchasing power parity. We have absolute purchasing power parity, and we have what? Relative purchasing power parity. But most time we usually make use of relative purchasing power parity because it's still more visible. Absolute is kind of rigid. And what is absolute here? Absolute state that the exchange rates reflect the different cost of living in two countries, right? Exchange rates reflect the different cost of living in two countries. For example, if a representative basket of goods and services costs $1,700 in the US and £1,000 in the UK, the exchange rate should be what? 1.7 to 1 pounds. So it's just like dividing the 1,007 in dollar divided by the £1,000. That's the exchange rate. That is what absolute PPP preaches. So while absolute PPP exchange rate may represent the long run equilibrium rates between two countries, they are of limited practical use in financial management. So it is not usually used in practice normally, the absolute PPP. Financial managers are more interested in market exchange rates than theoretical rates, right? This is where relative PPP is useful. So absolute is not bringing into the fact that, oh, inflation can actually drive what? Can actually drive an exchange rate. It's not bringing into the fact that even interest rates can drive it, right? It's not saying that, okay, if in US a basket of goods costs 1.7 and in UK it costs £1,000, the exchange rate is what? $1.70 to what? To £1. Now, if it's not limit, if it's of limited use in practice and is not actually realistic, then relative PPP what comes in. And what does relative PPP preaches? It says that claims that changes in exchange rates are determined by differences in the inflation rates in different countries. So inflation rate drives what? Exchange rates. That is where relative PPP is coming from. So for example, if the inflation rate is higher in the US than in the UK, right? Relative PPP predicts that the value of the dollar will what? Will fall relative to the what? To the pound sterling. Let me come again. If the inflation rate is higher in the US than in the UK, relative PPP predict that the value of the dollar will what? Will fall relative what? To the what? To the pound sterling. And why is this? If inflation rate is higher in the US, people will not want to do business in the US. The demand for dollar will what? The demand for dollar will reduce. That's the thought process around it, right? The demand for dollar what? Will reduce. And when the demand for dollar reduces, what happens to what? To the price of dollar. Automatically, the price of dollar what? The price of dollar drops. I don't know if you are following me. Are we here, please? And is it clear?
Yes, it's good.
Yeah. So the demand for what? The demand for dollar will reduce. And when the demand for dollar reduces, the price automatically what? The price automatically what? Falls. And the value
Okay.
what? Fall relative to the what? To the pound sterling. That's the concept around it. So that's why they say, because why? If people don't longer purchase dollar, what will they do? They will leave dollar. They will leave dollar and rather go to pounds. To what? To go rather go to UK and what? And do business in UK. And if they do UK, if they do business in UK, and the demand for pounds increases, what will happen to the currency in pounds? Please, I'm asking a question.
Can you
Hello?
can you ask the question? What did you say?
What I said this. I already said that. Like for example, if the inflation rate is higher in the US than in the
Yes.
UK, I said it means that people will not want to do business in the US, right?
Yes.
And if people don't do business in the US, what will happen? The demand for dollar will what? Will reduce.
Reduce.
And if the demand for dollar reduces, what happens to the value of dollar?
It's I think it depreciates.
Thank you very much. It reduces. The value what? Depreciates, right? And I said, if people no longer do business in US and they move to UK, right? What will happen to the demand for pounds?
To be higher.
And if the demand for pounds is higher, what happens to the value?
Value will be higher.
Thank you very much. So that's what this statement is saying. So that's why in relative PPP we say what? Inflation rate drives what? Exchange rate. And that is the thought process which I just explained, the practical view of it. Let's move on.
Yes.
Now, this is the formula. I don't know if you can see this. This is the formula where we have S1. S1 means what? Your expected spot exchange rate after 1 year. While SO, which is this one, means today's spot exchange rate, right? Meaning now. And we say spot means what? Now, immediate delivery, right? So if I want to forecast what my exchange rate will be after 1 year, which is S1, this is the formula. I use today's spot rate multiplied by what? The variable currency inflation rate as a decimal. Variable currency, and I divide it by what? By 1 plus HB. HB means what? The base currency inflation. When we talk about the base currency, it means the base country. When we talk about the variable currency, it means what? When we talk about the base currency, it means home country. Let me put it that way, right? Base country, right? And when we talk about the variable, it means what? The foreign, or whichever way. Now, what is spot? Spot rate should be put into the formula in the format: unit of variables, currency, unit of base rate. Thus, you can ignore this. Now, let's solve this is a question before us. So now, example: spot rate 1 January 20x6 is what? What? $1 90 cents per one per per £1. I want to ask a question, Z and squad. Please, Which one is the home? Which one is the variable? Which one is the base? From this
Okay.
statement,
I
this
think the
one,
base
okay?
the base should be
Sorry.
um the base should be pounds.
Why do you
The
say the base
variable
should be
should
pounds,
be,
please?
to be clear, the base is the base is the foreign country, right?
Yeah. When did I say the base is the foreign country?
I'm asking, is the base
Okay, no, no.
is the variable that is the foreign?
Yes.
Okay, the base should be pounds, yeah.
Thank you very much. Yes, the base is pounds. And
Pounds,
even
yeah.
most times, when you see design like this, you see this E1. Most times,
Yeah,
another trick is that's the base. Do you understand?
that's the base, yeah.
That 190 is variable, is changing. Do you understand? Your pounds here, which is constant at 1, will be constant. It is the base. Why this 19? Whatever happens to exchange rate, this one will be changing. This $1.90. That's the way you have it in naira. You know, when we're doing
Okay.
naira, we'll say naira is what? 1434 to one what? To $1. That
$1
$1 does that one, does it changes? It does not change.
no.
But the exchange rate in naira what will be changing. If it's 143
Hmm.
today, you will see 15 today. So that's the variable. And the constant one is the what? Is the base. So that is it. So dollar here is the variable. This the expo is even here safe. No wonder he got it easily. I've even
It's
forgotten that the
no
expo is
wonder.
here. The expo here is even before me. I didn't even know. And I was
I wasn't even looking at the screen.
okay.
Wow.
Okay.
Yeah.
Sorry, is squad. Squad, are you on this call? Or is only Z, because it's only Z's voice I'm
I
hearing?
am.
Okay, are you following, please?
Yes, please.
Please ask questions or anywhere you're lost and answer so that we know, because I don't know who is following at this point. I'm already sharing screen.
That's okay.
So
Yes, I
please,
will.
I want
Yeah.
to hear your voice so that I know that you're in class with me, please. Thank you.
Okay. You're welcome.
All right. So as we said, dollar is the what? Is the variable currency, and pounds is the what? Is the base currency. And we now have the predicted inflation rates for 20x6 and 20x what? And 20x7. The US is 2%, and UK is what? 3%. It means that what? US exchange rate is 2% for 20x6 and 20x7, and UK exchange rate is what? 3% for 20x6 and what? And 20x7. Then I say calculate what? The predicted exchange rate as at December 20x6 and what? And December what? 20 what? 20x what? 20x7. All right. So let's get on this. This is the point where I switch to what? To my Excel, right? So
Okay.
let me open an Excel. All right. So let me divide my screen. All right. So we have it here. So we already know that the formula S1 is what? Is equals to what? SO times what? 1 plus HC divided by what? 1 plus what? HB, right? This is the formula. Now let's not with this one. It told us that the spot is what? The spot is one naira, 1.90, right? So it means that if my spot is 1.90, how do I do it? 1.9 multiplied by what? Bracket 1 plus you we said US is the what? US is the variable. So it means that 1 plus 2%, right? Divided by what? Divided by 1 divided by bracket 1 plus 3%, right? I close both brackets so that it will not affect the this thing. So what do I have? I have 1.11. 1 point what? I have 1 point what? 1.88. Can you interpret this, please?
For the second one,
Yes. Why is it dropping?
you mean the exchange rate?
Yes, you can see that it was 1.9 as spot, and now dollar has dropped.
Because from the question, the inflation is better than UK, so the value is increasing.
Thank you very much. So let's move on. So they now said this is what this one is 20x6. This one is what 20x7. No, okay, no, this one is first 1 January 1 1 20x6 20x6. Now they told us to calculate 31st December 20x6 31st December 20x6, which we've done. Is this 1.88? So this one is 31st now. 12 31. Now they now told us what to calculate what 31st December 20x7. And you agree with me that first of January 20x7 is still the same thing as 31st 12 20x6. Abi?
Yeah.
All right. So what do I need to do? I just need to copy this and use this again. Right? Bring it here.
Mm.
Use this. This will not be the new spot. The 20x6 one will be the new spot. Please don't make mistake of using this 1.9. You know, exchange rate moves, right? Spot means
Yes.
immediate delivery. So when you are calculating for 20x7, you are using what 20x6 as the new spot, which is the current immediate delivery exchange rate. So and that is how we do what? We calculate what? Exchange rate using what? Purchasing power what? Parity. You're going to need it for your foreign operations. So please let that be on your mind. People make a mistake with this base rate and variable rate. I've already explained it in a very simple manner, right? Please don't forget it and don't make errors on that. Exam tension can make you even make mistake that normally on a normal day if you make that kind of mistake, you will slap yourself. That is me that make this funny mistake. And you know when your exchange rate is wrong, automatically what your final answer will be wrong. So let's move on. So that's that about purchasing power parity. Now we move to what? To interest rate parity. So interest rate parity holds that what? That the forward exchange rate is based on the spot rate and the interest rate differentials what? Between the two countries. When we're talking about interest rate differentials, we're talking about interest rate at which you can invest or at which you can borrow, right? Interest rate
Yes.
at which you can invest or interest rate at which you can what? You can borrow.
Mm.
So, and the formula is what? SO, which is 1 plus 1C, 1 plus 1B, right? Where 1C is the variable currency interest rate and the base currency interest rate is what? Is 1B. If spot is 1.78 per pounds and the dollar and sterling interest rates are 3.25 and 4.5 respectively, what is the what? 1 year what? Forward exchange rate. Can you please calculate that for me using the approach of PPP? And thus, I just want the answer. Squad, please calculate. Z, please calculate. If you calculate it, we're done then. There's no need for speaking too much English.
Mm. That's 1.75 or 1.76.
Okay, thank you very much. Yes, 1 point what? 1.76. That is the answer. So it's 1.76. I don't know if squad got that. Um So, but it's 1.76, and that's how you use what interest rates to what to that's how you use interest rates parity what to calculate what exchange rate. We now have what Fisher effects. These are effect of inflation rate, and real. You have questions where they will tell you, oh, we have the real interest, we have the real values, and we have the what at nominal, right? All this thing I'm telling you came out full fledged during my own time. I had to calculate using, I think then it was PPP. Also, Fisher effect also came out, right? Where questions relating to nominal, question related to real rate, real interest. They twisted that question in the way that there are some variables that are meant to be at real rate, and there were some questions that had to be at nominal terms. So in Fisher effects, they said countries with a higher inflation rate have what higher nominal interest rates to offer the same real returns as country with what with low inflation. What are they trying to say here? What they're trying to say here is that if your inflation rate is high, automatically what your nominal interest rate will be high. But you as an investor, you might think, oh, because the nominal interest rate is high, oh, I should go and invest there. But you have forgotten that inflation is eroding your investment over there. The person that has a low inflation rate and a low interest rate might even be better off than you that you went to invest in a country with a higher nominal interest rate and with a higher inflation. And that's why you will see it in Nigeria. Part of the model that the BAT economic team is bringing in, you notice that they usually drive NPR to inflation rate. So when they notice that inflation rate is getting higher, what do? They increase NPR. And when they increase NPR, what is happening? Prices of T-bills is going to increase automatically, right? When you
Just
increase when
NPL.
NPR, monetary policy
Mhm.
rate,
Oh,
that is
okay.
monetary policy rate drives business activities in Nigeria. And what do I mean by drives business interest rate? It's part of the tools of the CBN to manage money supply in the country, right? So if you are going
Mm.
on an expansionary monetary policy or or a contractionary monetary policy, you NPR is part of the tool that is used by CBN. And how does it work? NPR means what? It's usually the minimum base rate at which you can borrow money. Let's say for instance in a bank now. Let's say if for instance now the current NPR is 20%. If banks wants to borrow money, if banks wants to lend money rather, that would be the base. It means that we'll do 20% plus plus whatever returns we want to borrow, right? So if as a bank we are going to lend 20% plus whatever spread we put, with maybe let's say 4% spread, it means that I'll be borrowing at 24%. If NPR is 15% and my spread is 4, it means I'll be borrowing at what? I'll be lending at what? 19%. Now I want to ask you a question. If bank lend at 24, if banks lend at 19, what is the effect on business activity in the country? I just want to test your brain on that. If bank lends
If
at 24% and if banks lend at 19%, how does it affect businesses in the country and what's the implication?
um
Anybody, please. I'm with you.
if the bank lends at 24%,
Yes,
compared to what
to
compared to what
19%. 19,
the 19, is it the government rate or what?
not the government rate, banks lending rate.
Like two different rates.
No, what I'm saying is, I said if a bank lends at 19 and bank lends at 24, how does it affect business activity? It's an all statement. If me as a bank, if Access Bank, if I currently lend at 19% or if I lend at 24, how does it affect business activities in the country? That's the question. Okay, let me help. So I know I told you that today we are going straight to the point. So, like I said, I talked about NPR, and I said NPR is a tool that the government uses in managing business economic flows in the country. Meaning that if NPR is high, it means that banks will lend at a higher rate. If NPR is low, banks will lend at a lower rate. If banks lend at an higher rate, what is happening? It means that you are trying to reduce money supply in the country. Because why? The meaning is that people will not want to borrow when interest rate is high. And when interest rate is high, when people don't borrow, banks will not able to lend money. And if banks is not able to lend money, it means that money will not be in circulation, right? And if money is not
Yes.
in circulation, what will happen? Inflation will reduce. Because it's when money is in circulation, that's when there will be money to buy goods and services. And when there's
Yes.
enough money to buy goods and services, what happens to the price of goods and services?
It
Goods
will
and price.
increase.
Thank you very much. This is economics I drifted into. Do you understand? And vice versa also. If they what? If the exchange rate if the MPR reduces, what will happen? Banks will be able to lend at a lower rate, and if banks is able to lend at a lower rate, money will be available in circulation because people will be
Yes.
what? People will be motivated to borrow, and when people are motivated to borrow, people will what? Will put it into businesses. Businesses will expand. There will be a lot of workers will what will come on board, right? People will want to work. There will be jobs available for people because there are businesses available. When that happens, what do we call that? We call that expansionary what policies. And if that is called expansionary policies, what's the effect of that? Inflation is knocking on the door, because when people have too much money to do what, goods and services will what will be increasing, because there's too much money chasing those goods and what and services. What do we call that kind of inflation? Demand pull what inflation.
Yes, sure.
This is just economics I entered into. So that is the idea of Fisher effect, right? And then you have it here. 1 plus I. I is the what? Nominal interest is what? Is 1 plus R, real interest, plus what? 1 plus H, which is the what? Inflation. It means that if I want to get nominal terms, what I just need to do is that multiply my what? 1 plus R plus what? 1 plus H. I will get my nominal. So there's some questions in the exam that they will tell you lots that they want it in nominal terms. If it's not in nominal terms, right, that they want it, it means that they've given you those values in what? In real terms. What you're expected to do is what? Is convert it to what? To nominal. Do you understand? You will see. That's why you will see some questions. They will say inflation. Inflation is 5%. You know what do we normally do when we have those variables? Sales revenue, inflation rate. We what multiply that sales revenue by the what? By the inflation rate. Abi, you've seen questions
Yes.
like that, Shay. That is
Yes.
what?
Yes.
That's you converting that real value into what? Nominal terms. That is just the meaning. That's what you've done. Those values are given to you in real terms. When you apply when you apply that what that inflation rate, you are converting it to what? To nominal terms. And there are some questions that they will give you in nominal terms. They want it in what? In real value. What do you need to do? When you have the nominal value, you just divide it by the what? By 1 plus what? Plus H, which is the inflation rate. You get what? The real what? The real term. All that, it might be useful for you when you're solving questions. So we move. Now, what are the issues? Let me book back on slideshows. What are the issues to look at in foreign projects? We have one, currency risk, right? Foreign currency risk means that what? Forecasting exchange rates, and which I've already explained, either through what the PPP what or the IRP model. These ones will always come out. They will tell you to forecast exchange rates. So those are currency risks. We also have political risks. They may say, oh, political risk can involve maybe remittances restrictions, taxation in the country in which you are investing, which it can be what? Double taxation treaty, withholding tax, and all those things. So under political risks, we have what? Taxation issues, right? This is government matter, so it's a political matter. So government might say, oh, I'm not doing double treaty taxation, right? And if government is saying they are not doing double taxation treaty, you pay on your own. It means that you pay in the foreign subsidiary, you also pay what? Tax in the what? In the home what? In the home subsidiary. And also withholding tax, whichever way the question comes. We now also have remittances what? Restrictions. So they may give you a question on foreign operations, and they may ask you, okay, um let's say for instance now, they are invested in China, but China is trying to protect its industries and is trying to protect the outflow of funds outside of his what? Of his country. They may say, oh, if I invest in China and I have a subsidiary in China, normally if things being equal, if China investment makes 100 billion, in my dividend policy, I might say they should remit the 100 billion yen to me in
Yes.
Nigeria, right? Abi?
Yes.
Because I own
Yes.
them. I can say remit 50, I can say remit 40. But
Yes.
when there's a remittance restriction, so some countries they usually put this remittance restriction, meaning that there's a cap in which you can remit, that can be remitted. They may say, okay,
Yeah.
whatever earnings that is made in China, it can only 30% can come to Nigeria.
Okay.
I can argue that I own this company in China now. Why would you not put all this restriction? Why do you think I invested in China? I invested in China so that my business can grow, so that I can get the value of my investment. Why are you not putting restriction? But can you fight China's government? You
No.
cannot fight China's government. What do you need to do? You either need to align or look for ways, loopholes to what? To get those money back. So if China is saying I can only get 30% yearly for my investments in China, right? My
Yeah.
subsidiaries, my fully owned subsidiaries, what do I need to do? There are ways in which we can package it that will still be getting our monies back through what? Transfer pricing.
Yes. Okay.
Do you understand? Transfer
Yes.
pricing. Also, management or service fee. That's why you see some countries, they'll be saying they are sending expatriates, right, to those foreign subsidiary. So let's say, for instance, now I have an engineer in Nigeria. It's not that there's no engineer in China that can do that work, oh, but we'll send our home engineer. And when we send our home engineer, what do we do? So normally, let's say in China, the engineer that would have been on the deal in China, maybe the person is supposed to collect 2,000 yen. But by the time we
Mm.
were sending our own engineer, we are going to increase that fee to like 10,000 yen as his fee. What are we trying to do? We are using style to remit money back to the business. Do you understand?
Yeah.
Because
Yes.
if they pay the engineer 10,000, that money is not going to the engineer directly, it's coming to us.
Yes.
Do you
So I
understand?
have a question. I have a
Okay.
question.
All right.
This this remittance restriction, like the transfer
Yeah.
pricing
Yeah.
and all this one like this,
Mm.
it will be like an expense in the like when you are estimating the net present value, right? In their like the base country.
Home country.
What
When you say base, is that the local country where the main
no, where
investment
you
is,
are
or what?
no the counter country rather, the
Okay, the
country that you are
foreign.
investing, the foreign
Okay.
country.
All right.
Then in our own currency, like in our
Yes.
part, the second
Mm.
aspect of kind of exchanging that yen to
Mm.
Nigeria,
Mm.
will it
I'm
be
with
an
you.
income? This
So
this will it be an income, and how do we go about
no,
like the
it will
management
be
fee,
an
all
income
of
now.
this?
It's like that way I explained it to you now. You know that management fee, right?
Yeah.
That management fee. I told you that if if they pay management fee, right? If they pay
Mm,
management fee, right? One,
mm,
it will be an expense in the foreign currency, right? Because it's the foreign subsidiary that will be paying to us. Do you understand? So in
yes,
the foreign currency, it will be in yen. Let's say China,
yes,
right? It will be a cost to them in yen.
yeah.
It will be an
Mm.
income to us in dollar term, in naira term.
So one question is, are you accruing it as income 100%, or there will be like a cost element in it?
When you say cost element, I'm confused.
Like if you are putting it as income to us, will it be hundred
Mm.
percent, or there will be like a cost element, like this transfer pricing? For
I
example, you
understand
are
what you're
putting
saying.
as
I understand what you're saying. I understand what you're saying. Well, normally sometimes, yes, there can be some cost elements. It will be in the question. Do you understand? If there's a
okay.
cost element to that service that was provided, right? It will be a cost to you, your own cost in the home
So,
country. Do you understand?
so what? Sorry. What we are now bringing back will now be like the net, right? Just in
Yeah,
case a
yeah,
question,
100% is usually the net you are bringing back now. Do you
just the
understand?
net.
Because
Okay.
because the cost you would have brought it in your home country, you'd have factored it, right? The income too, you'd have factored it. By the time you add the income plus the cost, is the net you are getting. Do you understand?
Okay. Okay. All
Uh-huh.
right.
Yeah. All right. So we have what? The transfer pricing, we have what? Management of service fee. We can also do some structure arrangements like intercompany loans, right? So you may say, oh, the foreign subsidiary, we will lend them money. Sure, you understand the intercompany loans. And what's the idea of this lending them money? We are going to charge them what? Higher interest. So that what? When they are paying interest, they'll be paying to us at a what? So instead of let's say normal interest borrowing in China, maybe it's just 5%. We were going to charge them at maybe 10%. All this style is just to what? To repatriate our money back into our what? Into our country. If what? If there are remittances what? Restriction. Are we fine? Can we now solve
Yes.
a question?
Yes.
Yes, please.
All right. So let me. I would have sent that. I would have dropped it on the WhatsApp. Okay, let me share a question on the WhatsApp. Thus, I will share. Let me stop sharing for now and get the question out. Um, so you can go to the main page to get the question that I'm sharing now, so that we can. All right. So I think. So please check the page if you can check the screen if you the our WhatsApp. Can you see it, please?
Okay.
All right.
We'll check.
So please download it ASAP
Okay.
so that we can start. I'm sharing the second one so that we'll be solving today so that I will have to. So is the Ilandwe's question you are hoping, please? So
Okay.
Ilandwe's question. Yeah. So let me know when you've opened it.
It's opened.
All right. Squad, you can also confirm that you've opened it, please.
It's really very long question.
What did you say?
I say it's a very long question.
Yeah, so I told you now it's a 50 marks question now. That's why I wanted us to start early. So we're already entering into 50 marks questions. I'm going to bombard you with a lot of 50 marks questions to the extent that when you see investment appraiser and what have you mergers and acquisition, you say, Mr. Shegun did a good job. We know all these things is water. So so yes, so all right. So maybe should I just give us like 3 minutes to go through it, right? While let's give you let's go through it, please. Go through it is just brush it. Just brush it. You don't need to read. Don't do deep reading, please. Just and this because we're still going to. It's just for you to have an overview of the question. And let me know when you are ready. I think 3 minutes is enough, please. Hello, are we there?
Yes, sir.
Is it the question we're still reading?
Um, we are waiting for you now.
I was expecting you to prompt me when you're ready now. That's why I said when you're done, just let me know.
Oh, okay.
Ah,
We are done.
okay. Please, we have limited time. Eh. Please, all right. So let's start. So how do we see that question? Do you like what you see?
It's very long, that's all.
It's very long, Abby. But it looks simple, Abby.
It's not simple. It's very long. Many information.
Many, many. Okay. Okay. All right. So let's start. My Z is acting up. Can't see my coming. I can't see my mouse. I don't know why Excel has been acting up this way. Let me reload. Let me reload my Excel, please. Hold on. Mm. All right. So it's fine now. All right. So let's kickstart. Let's kickstart. Let me share my. You can see my screen, right?
Yes, we can.
All right. So let's first go to the requirements first. Sharp, sharp. Excel is really acting up.
Discuss the possible benefits and drawbacks.
So they said one, discuss the possible what benefit of and drawbacks to Imonico setting up its own assembly plant in what in Yilandwe compared to licensing a company based in what in Yilandwe to undertake the assembly on itself. And two, prepare a report which evaluates the financial acceptability of the investment in the assembly plant in Yilandwe. Discuss the assumption made in producing the estimates and the other risk and issue which Imonico should consider before what making the final what decision. Provide a reasonable recommendation whether or not Imonico should invest in the assembly plant. Right. So this is a what? And then I said professional marks should be awarded for the demonstration of skills in communication, analysis and evaluation, skepticism and what and commercial acumen. What does this mean? This is a cheap mark. This so it means that even if you don't know anything, but for the fact that you can communicate well, you apply commercial acumen, analysis and evaluation and skepticism, you have 10 free marks out of 50 marks. And in this exam we're writing, 10 marks is what it's not joko. Is it can change one's level from either coming back to write the exam or passing. So let's move. Let me just quickly run it, right? So we have here, we say Yilandwe, whose currency is the Yilandwe rand, right? YR, has faced extremely difficult economic challenges in the past 25 years because of some questionable economic policies and political decision made by its previous government. So Yilandwe is a what? That's a country. It's not a company. Is a what? Is a country. Note that. Although Yilandwe's population is generally poor, its people are nevertheless well educated and ambitious, right? So you can see that these are economic issues. You should note that when you are writing your points and you are adding context to all those writing parts, these are points that you can use. Please note that. Also, just over 3 years, a new government took office. What does this tell you? This telling you about political risk. Are we following? I'm just giving you tricks on how you can flesh up your writing part, right? This is a problem on on political risk. A new government just took over, and you know when a new government takes over, it's possible that the policy of the past government can be stopped immediately, right? And they will bring in new policies. The new policies they are bringing in, we don't know. Only God knows. They may say, okay, maybe before in the previous government, there was no remittances restriction. But in this new government, there may be remittance restriction. So that's a political risk. So please, when you're adding up, the examiner will know that yes, you are inside the question and you know what you are doing. All right, let's move on. So it now says just over 3 years, a new government took office, and since then, it has imposed a number of strict monetary and fiscal and fiscal and fiscal what's this and fiscal controls. Please mute your mic if you are not speaking, so that the noise in the background will be reduced. Right. So in assets, including an annual corporation tax of 40, in an attempt to bring Gilandwes out of its difficulties. As a result, the annual rate of inflation has fallen rapidly from a high of 65 to its current level of 35. So we can see that inflation rate is dropping. This is a good news, right? The new government is trying. These strict monetary and fiscal controls have made Yande government popular in the larger cities and towns, but less popular in the rural areas, which seems to have suffered disproportionately from the strict monetary and fiscal control. Normally when government are doing these strict monetary policies, the way Tinubu is doing it, who suffers the brunt is we we are the rural level. But people like you, Z, that are rich and squad, you don't get the brunt of it. It's we that we are hustling that gets what the branch of it and suffer mostly. So let's move on. So then I said it is expected that what the land based annual inflation rate will continue to fall in the coming year, and they gave us what the inflation rate from year 1 22, year 2 14, year 3 what 9.8. Then I said the land government has decided to continue the progress made so far by encouraging what FDI into the country, right? Recently, government representative held trade shows internationally and offered businesses a number of what of concession. I told you the last time, if you remember when we were explaining PPP and IRP, I made mention of it that if inflation rate is high in a country, what happened to investor? They leave that country, yes or no? Do I have people following me, please? Hello, Z squad, are you there?
Yes, we are here.
Please, so why are we kind of lagging now? Please, I want
Yes,
us
we
to
are,
be
sir.
please, just please respond on time so that I know you are following me. So I know I said it the last time. I said when inflation rate is high, what happens to investors? They leave that country, right, to invest somewhere
Yeah.
else. So you can see it here that Yolanda has tried to reduce the inflation rate, and you can see that in year one, 22%, year three they expect 9.8, and after that paragraph, what did you see, what after that what did you see next in the paragraph? They say Yolanda government has decided to continue the progress made so far by encouraging FDI, meaning that, oh, we have reduced our inflation rate, please come and invest in us. That's that. Now, did I said what recently the government representative held trade shows international and offered businesses a number of concessions. And what are the concessions? They said zero corporation tax payable in the first 2 years of provision, meaning that, okay, if you start your business, we are not going to tax you. We're not going to tax you for 2 years. Which is a good thing. If you are not going to tax me for 2 years, at least you allow me scale before you start taxing me. And also an opportunity to carry forward your tax losses and write them off against future profit. It means that in the first year, if you make a loss, let's say in the third year you make a profit, we are going to allow you reduce your profit by that your loss, and they will not tax it, meaning that you are going to be paying a reduced tax amount because we are going to offset your losses in the earlier years. And that's how the question is. The government representative also promised international companies investing in United prime locations in towns and cities with good transport links. We now move to Imonico. Everything we've said in that first paragraph is about the government. Now, Imonico is a listed company based in USA, meaning that Imonico Group's company is in US, right? So from this we can suggest that the base country is US, while the
Okay.
foreign country the foreign is Zilandwe, right? As its
Yeah.
currency, manufacturing high-tech diagnostic components for machinery, which it exports worldwide. After attending one of the trade shows, Imonico is considering setting up an assembly plant in Yilandwe, meaning that we want to invest in Yilandwe, right? Where parts will be sent and assembled into a specific type of component, which is currently being assembled in USA. Meaning that we are currently doing this thing in USA, but because of all the good things we've heard that is happening in Yilandwe, we feel that, oh, if we do that in Yilandwe, it will be cheaper for us than doing it in USA. What does that suggest to you? Let your brain be going to lost contribution, right? Lost contribution. Let's move on. Once assembled, because why? They will not be using that space in US anymore. They'll be using the one in Yilandwe, meaning that space will be redundant in USA, meaning that is a cost to us. Lost
Yes.
contribution. Note that,
Yes.
please. Once assembled, the components will be exported directly to companies based in the EU. This export will be invoiced in euro. Now, we now move to the assembly plant conversation. It is initially assumed that the project will last for 4 years. So what am I doing? 4 years. As a smart guy, I will just move straight. And most times calculations at advanced financial management is called appendix. It's done in an Excel. It's whatever you get in that appendix that you now move to your word as final answer and use for your for your evaluation and analysis in words on your word documents, right? So I move to
Yes.
this place. I don't waste time at all. As a smart guy, I write appendix, right? Whether it's appendix or X, I don't know. Anyone. Just note that is appendix, right? So I come here, I put they said 4 years. I start putting in my numbers. I know that, okay, there will be now, which is year zero, there will be one, there will be two, there will be three, there will be four, without wasting time at all. No time to waste. So I come here, I put here. I've done this, right? Even before putting topic. Okay, they say Yolande. Let me just put Yolande. Ilandwe, right? Let me just leave it like this, Ilandwe for now. You can flesh it up if you like. So yeah, right. So they said it is essentially assumed that the project will last for 4 years. The 4 year project will require investment 21 million. Okay, so I can say maybe let's put this thing in millions, right? In YR, because this is the country we are going to first work on, which is the investing company, in millions, right? Let me leave it like this. So we already have this. It's already in millions. You don't need to put 00 here anymore since you've stated in millions here. All right. So we move on. So these are the cost of the investment, right? We have land and machinery. 21. We have land. 21. Land and building. We have plant and machinery. 18 million. And we have what? Working capital as what? As 96. Well, you know, the beauty about this is that you can play with Excel. So if I want to do it, I can quickly come here, right? Without wasting time, because this is Mark 2, working capital, right? In year zero, it will be what? He said the working capital will be what? Made what? Immediately. Note that. So if it's made immediately, it means that it will be made in year what? Year zero. So I can just quickly come here. Working capital, what? 96. I put it here, right? It's an outflow, right? So it's going to be in what? It's going to be in minus. I come here too. They've told me that the what? The land and building. So you don't need to waste time. Just be plugging immediately. Be plugging. That's how you can build speed though. In exam hall, nobody it's time. Time is even the most critical part. Right? So you just start building. No, you don't need to read question finish self. Just start building. Uh machinery. What is machinery? Okay, machinery is 18. I flog this one. This one has been sorted. I move on to the next. They said, they said the working capital will need to be increased annually at the start of each of the next 3 years by Yilandwe's what? Inflation rate. So what is driving what? My working capital is what? Is the what? Inflation what? Inflation rate. Meaning that it will be increased by the what? By the inflation rate. The question will now be, what is the inflation rate? We'll get to that part. So it means that if I can immediately I can start doing my workings too. Excel, we can be inserting. So I'm fine. Let's say it was written paper now. You can't do all this one I'm doing. No. Let's say you create space to the end that you know that okay, it should not be affected. So I can even quickly come here, working capital, right? This is the working capital, right? What's my Excel? I can't see the cursor. What's wrong? Oh, what's wrong with my Excel today? Hold on, please. All right. So I think it's back now. Okay. So working capital, right? We said is 96, right? If it's 96, it means that, let's say for instance, we can just quickly put something here, inflation rate. We don't know that one yet. As we read, we'll know that one. But let's just put inflation rate, because year one will be driven by inflation rate. It means that in year zero, it is what? Is 96, right? So we'll leave this one like this. Just leave this one like this. Let's move on. Please, if you're not clear, let me know. I'm assuming that we know this thing, so I'm not going to be taking it like as if I'm taking at the lower level. So the working capital will need to be what? Increased annually at the start of each year by what? The inflation rate, right? And it is assumed that it will be released at the end of the project life. It can be assumed that the assembly plant will be what? Can be built very quickly and production start almost what? Immediately. This is because the basic facility and infrastructure are already what? In places, as the plant will be built on premises and grounds of a school. The school is ideally located near the main highway and railway. As a result, the school will be closed and the children currently studying there will be relocated to other schools in the city. The government has kindly agreed to provide free buses to take children to these schools for a period of 6 months to give parent time to arrange what? Appropriate transport in the future for their children. What has this done? We've done something, because of our business now. We are affecting what? The children's school activity. That's an ethical issue. Note that. It's an ethical issue because now we are going to create more costs for their parents. Because why? If this what we are doing is going to be near the school, and the school will have to be relocated, it means that some children, maybe their transport fare is just 5 naira, maybe it's not far from the house. As a result of this location, what has happened to some parents, it might be a far place where the parents might not be able to fund for their children's school fees. So this is an ethical issue that might need to be looked into. You can note that as part of your written this is. So when you are solving questions like this, don't just read to have a broader view, so that you can be jotting some small points that can be useful for your for the writing part. Very key, please, so that you won't waste time. Now we now move to numbers. Now they said the current selling price of each component is what? Is 700 what? 700 euro, right? 700 euro, and this price is likely to increase by what? By the average EU rate of inflation from what? From year one. Now, what is this trying to let you know? It's trying to let us know that what? That this price is a what? Is in euro. If this price is in euro, what's happening there? It means that what? For us, if we are working with Yilandwe, we must convert it to what? To Yilandwe. Abi?
Yeah.
Thank you very much. So now they said the current selling price of each component is 700, and this price is likely to increase by the average EU rate of inflation from year one onward. They're just giving us inflation rates back to back. Now, the number of components expected to be sold every year is as follows. Sales component is 150, right?
Yes.
480, 730, and 360. I can also come here and start doing all those ones without wasting time, right? I can come
Yes.
here and start doing all those ones without wasting time. Now, they've told me that this year zero. They've told me that in year one, this thing will be 150. Maybe I should just put the years here so that I will be seeing it. So what do we do? So 150, 480, 730, 360, right? They've told us that. Now, they've also told us that what? The selling price will increase by what? So now what's the selling price? They said the selling price currently is what? 700, right? Let's note that. The selling price is 700. If the selling price is 700, they said it will increase what? By the average EU rate. Now let's even go to average EU rate so that we won't waste time. Down we have it. The average EU rate, we have it. Let me see. These are forecast future. These are futures. Okay, this is expected inflation rate. They said EU's expected inflation rate will be what? Will be 5% for the first 2 years, and what? And then year three will be what? Will be 4%, and year three onward will be what? Will be 4%. The last one is USA. So we'll come here. EU inflation rate. Right? This is the selling price, 700, right? Let me put inflation rates up here. That's how the selling price will increase by the inflation rate. So in first year, they told us what? 5%, right? For the next 2 years. They now told us what? From year three onward, it will be what? 4%?
4%.
4%, 4%. So it means that
4%.
what? Our selling price will grow like this. Right? So So that means these are our selling price with what? These are to grow. Is that clear?
Yes.
5%, this one 4, this one this. So that's that about that. Now, we now move on. Let's be taking it small by small like that. This 150, don't forget that this one up. I don't know what my Excel has done today. I can't see the the icons, and I don't know why. And it happened even on it happened on my office system also. I don't know what's happening to Microsoft Excel.
Have you updated?
Maybe that's the problem. I don't know. Because even on Friday when I was working in the office, even with my other system in the office system, it gave me this same issue too. And I don't know why. So I don't know whether it's Excel or the so we'll be managing it. So that's this. So that one is done. Let's move on. Is there any other thing? Mm. Don't forget that this one that we did at first, that 154.80, these are what? This is sales, the amount out the volume. This year 154.80, the one after the workings.
It's in thousands.
Yes, in thousands. Yes. So the sales component unit is in thousands. Is in thousands.
Hundreds of thousands.
Is in thousands. All right. So let's continue. So we've gotten that. I want us to be taking it one by one, the way the question is flowing, so that we won't miss anything. So that's the selling price. That's 700. We've cleared that one. We've cleared that one. We've increased it by the inflation rate. The component unit, we've also factored that one. 154.80. We brought that in. So let's move on. Now say the part needed to assemble into the components in Yilandwe will be sent from the what? From the USA. You can see problem. The first one we have, that one is in pounds. The selling price, that one is in pounds, right? The
Yes.
part that is coming, they said is in what?
US.
Dollar.
That's dollars.
So you can see problem.
Can
So
we
now they
just
said
directly convert the selling price to Yolande directly first?
no, no, but we're going to do that. Let's
Okay.
just take it step by step. Don't worry. We are getting there. We are going to do that. Right. We're going to do that. Don't let us rush it. We're going to convert it. Don't worry. There's a way we're going to convert it. I don't want us to just jump at it like that. Let's just take it step by step like this. All right. So, who did I offend?
The cost. Oh, okay.
This is my. Hold on, please. I don't know what's happening. I can't even say anything. I can't see. And all right. Let's also. God, please help us on this. So this is not funny. All right. The parts. They said the parts what at a what? The part needs to assemble into the components Yilandwe will be sent what from the US at a what? At the cost of what? $200. Right? If it's $200, so how do we bring that in? It means that it's the part, right? So we're bringing it in, and we'll also be what? We'll also be converting it per component. The variable cost relating to hold on. At the cost 200 per component, from which only we currently earn a pre-tax contribution of $40 for each component unit. However, Imonico feels that it can negotiate with the Yande government and increase the transfer price to 280 per what? Per component unit. What does this tell us? Now, that part, they are saying here that the part needed to assemble into the components in Yande will be sent from the US at a cost of 200, from which Imonico would currently earn a pre-tax what? Contribution, meaning that by the time they sell, if it will be sent from the USA by Monaco, it means that it will be a selling price what? For 200, and the cost might have been like 160. It means that Monaco would currently what? Earn 40, meaning that if he sells it to the foreign subsidiary at 200, that means its original cost would have been 160. For it to say it will earn what? A pre-tax contribution of what? Of 40 for each component unit. Let's hold that. But now said, however, Monaco feels that it can negotiate with what? With Ilandwe government and increase the transfer price to what? To 280. Now, if it's increasing the transfer price to 280, what does this tell us? It means that the new cost will now be what? 280, because what? That will be the cost at which what? The guys in the overseas company will be what? Will be buying it. Is that clear?
Okay. Yes.
So let's plug that in.
Okay. Can I ask a question?
I'm with you.
Okay. So what would now be like the income from US? Will it be 40 plus the 280?
No, it will not be 40 plus the 280. It will be 40 plus 80.
Plus 80. Okay.
Do you understand why it's 40 plus 80?
No, I don't. But
Because
let's
why?
just okay.
Let me tell you why. You asked a very good question. For the US, naturally they are earning a pre-tax contribution of what? Of 40. That's their net income,
Yes.
right?
Yes. Yes.
And normally initially they would have sent it at $200, right? And they said they were
Yes.
in a pre-tax contribution of 40. It means that if they are sending at $200, it means their cost of production is 160. Abi?
160. Yes. Yes.
If it's 160, and now they are earning currently a net income of 40. If they increase their transfer pricing from 200 to 280, it means that their cost will still be 160, but what? Their transfer pricing will now be what? At 280 instead of 200. 280 minus 160, what will it give us?
As 80. No, not 80. 160.
I said
No,
280 minus 160.
minus 160. It will be 120, I think.
Thank you. That's why I said the net income will be 120. Do you get now?
So that's inclusive of that 40, right?
Yes.
Okay, so there's no need for 40 plus 120. It's just 120.
Because it's 40 plus 80. 80 is the extra money that they're increasing the transfer
Yes.
price by.
Yes. Yes.
Do you understand?
Yes, I get you.
All right, so let's move on. So for that one, what do we do? So now, cost price. This one now, so that we'll not forget to. This one. No, this one is in what? This one is in dollar. Abi? No, this one is in pound. Is in euro. Abi? This one is in euro. Don't forget this one. Now let's go to the cost price. Now that they are using transfer pricing, right? It means that my price will no longer be 200, it will be 280. If it is 280, what do I need to do? I don't understand though. Maybe I should restart my system. What do you guys think?
It's fine with me.
Please, squad, and let me just restart, because I don't like the way this thing is
Okay.
I don't like the way is let the recording continue. Let me just restart from here. It's really messing it's slowing me down. 15,960. Let's do that. Now say the current annual fixed cost of the plants are what? 4,600. the annual fixed what? The annual fixed cost, right? Let's keep that one too. This one is in what? This this one is in what? Is in YR. Let's note that. I'm intentionally putting on the rate so that we will not miss them. So that when we're converting, we know the one we're converting, we know the one we're not converting. They said the fixed cost. That one is what? That one is in million. Let's note that to 4,600 million. So that one is in million and is in wire million. That one is what? That one is 4,600. Let's leave that. Now, they now said all these costs, wherever incurred, are expected to increase by that country's what? Annual inflation every year. All these costs, wherever incurred, are expected to increase by what? By that country what? By that country annual inflation rate. So meaning that this 15,960, right, is going to increase what? By the exchange rate. By the what? By the inflation rate. And what's the inflation rate for YR? Let's go to that place where we saw inflation rate. YR inflation rate. Where is it here now? Okay, this one is European Union. This one is USA. Where's YR's on? Let's go. Let's see. Let's see for now. Okay, so this is it here. You can see they said it is expected that Ilando's annual inflation rate will continue to fall in the what? In the coming few years as follows. They put year 1, 22, year 2, 14, year 3, 9 what? 9.8. So we'll come here. For this variable cost, it will be what? It will increase by what? By its own what? By its own country. So the country what? First year is what? 22%. Second year is what? 14.7%. Third one is what? 9.8%. And the fourth one is what? 9.8%. Now we grow it. This kind of question, you calm down, you don't rush because you can make error easily. So that's that about that one. That one is sorted. Let's now see the fixed cost one. Apologies, just a sec, please. My son is at home today. He's showing me premium shige. All right. So for the fixed cost, they also said the fixed cost is also going to grow by, because they said all costs are going to grow by that by the annual inflation rate, right? So we do the fixed cost also 4.6. We grow down one too. That one is sorted. We leave that by that. We move on. Let's look for other things that we need to bring in that we are yet to work on. All right. So they now said Imonico pays an annual rate. Okay, that one tax rate is 20. The tax in both the USA and United is payable in the year that the tax liability arises. A bilateral tax treaty exists between them, blah, blah, blah. Tax allowable depreciation is 25 per year on the machinery. Okay, so before we get to, okay, we've noted the tax zone. The next thing, Imonico will pay annual royalties from the assembly plant to be made every year. The normal annual royalty fee is currently 20 million what? $20 million. But Monaco feels that it can negotiate that this with Ilando's government and increase the royalty fee by what? By 80%. Once agreed, this fee will not be subject to any what? Any increase in the what? In the 4 year, um, 4 years, what they call it? In the 4 year period. So now let's move on to that one. Let's work on royalty fee. So royalty fee, they said it's currently what? royalty fee is currently $20 million. Now, if it's $20 million and they want to increase it, so it means that if they're increasing it by 80%, so that means 20, right? 20 multiplied by 1 plus 80%. That's 36, right? This is 36. If this is 36, if this is 36, it means that let's leave this for now, 36, because they said it's not going to change, right? It's going to be the same, right? If it's going to be the same for the years, so this one is going to be fixed. We're not changing anything. So this guy, but in the question they said it is what? It is dollar. Let's note that. Let's move on. Once agreed, this fee will not be subject to any inflationary increase. So we're not applying inflation. So let's leave that. If Monaco decides to invest in an assembly plant in Ilandwe, its exports from the USA to the EU will fall, and it will incur what? Redundancy costs. That's what I was saying the other time. If Monaco decides to invest in an assembly plant in Ilandwe, its exports from the USA to the EU will what? Will fall, and it will incur what? Redundancy costs. As a result, Imonisco after tax cash flows will reduce by the following what amount. So they talked about the redundancy cost, right? Redundancy and loss contribution. We'll know whether it's in dollar, whether it's in pounds, or whether it's in this thing. They didn't state it here, right?
Sorry to cut you in. That
All right.
royalty fee. I
I'm with
noticed
you.
the question wrote 20 million, and it says it's going to increase the royalty fee by 80%.
Mm.
But you got 36. Can you please explain?
Look at now. They said it's 20 million, but they are increasing it by 80. So this is 80.
Okay. This royalty fee will be a cost, right?
Yes.
And also a revenue too.
Yes.
Okay.
All right, let's move on.
Can continue, sorry.
Okay. All right, so we've talked about the royalty fee. You now said once agreed, this fee will not be subject. We've said that. So we talked about redundancy costs, right? So they said it's Imonico that will face it. So if Imonico is facing redundancy costs, it means that it will be at, that means nobody needs to tell us that this 20,000 as we have it is going to be in the local currency. Do you understand? Because it's the local currency that is bearing that redundancy. So if the local currency is pounds or euro, as this case may be, it will be in that local currency's cost. Do you get?
Yes.
Yeah.
I just want to be clear. The e-money is a US or a euro? Because I can see 3 currency here.
I'm telling you that I tell you that this question is a sweet stick question. The question, so from the question, the base, I think the base is in dollar. The home currency is dollar.
Okay. So
The home
this
currency is
loss
dollar.
contribution like this is in dollar.
Yes.
Okay. Not in
So
euro.
no, it's
But
not in
why are
euro.
they
It's in
not
dollars.
saying,
What did you say?
why are they incorporating euro to it?
Let's go back to the story now. We'll go back so that we'll know why they are doing that. They said so. Now if we are going to do this, so can you see now? So normally the home country, right? The group is in US. Just hold that, right? The group is in US. Normally they produce in US and they sell in Europe. So they produce in US, assemble in US, and they sell in Europe. Meaning that their remittances is what? Is in euro. Hold that first. Their remittances is in euro. That's where they sell their products. Now, instead of assembling in US, they want to go and assemble in Ilandwe. From Ilandwe, they will now sell to euro. Do you get?
Okay.
So meaning the production is done is in the production is either done in US or Yilandwe, but the end goal for all this production is Europe. So meaning that their selling point is Europe. Do you get?
So the remittance will be in euro, right?
Thank you very much. That the selling price is in Europe. So the remittance, their sales revenue is in Europe. Is in Europe.
Okay.
So meaning that if the sales revenue is zero, you know that if Yilando is not the one assembling now, right, and selling
Yes.
to Europe, it means that Europe will be remitting to who? To Yilando, and Yilando will be remitting to who? To to US.
So
Do you understand the
yes, yes.
flow?
Yeah.
So that's the chain. You can see it's a sweet question. It's 50 marks. It's not a joke. It's not a joke. So
I'm just trying to understand that.
yeah,
So it means some of these the transfer pricing and royalty will even be converted to euro.
no, not zero now. It does not nothing concern transfer pricing with whatever transfer pricing is with Yilando and
Almost
Europe.
euro. Okay.
Mm, sorry, Yilando and US. That's the transfer
Yes. Okay.
pricing conversation now.
Okay.
The only business
Okay.
in Europe is we are selling goods there. It's only sales, and that is why selling price. If you look at that selling price, is in euro. Do you understand? This is the only
Okay, let's
factor
just
that you can see.
continue.
That's why
Let's
you see
continue.
that. We'll continue. Don't worry. But let me
Okay.
give clarity more. That's why you will
Okay.
notice that this selling price, right? What denomination is this? This zero. Can you see?
Yes.
And if you look at
Yes.
others are what? All these costs, they're either in dollar or in what? Or in Zimbabwe currency. That will give you a better picture that the only business is that, let me give you an instance. I'm in Nigeria. Oh, I'm producing laptop. If I produce in Nigeria, it's more costly. I produce in Nigeria and I sell my laptop to Ghana, right? If I produce in Nigeria, Ghana is where I sell it. So it means that if I'm producing in Nigeria, I'm getting Ghana cedis as my remittance. Is that clear?
Okay. Because
Now,
you said something about the final remittance will be in euro. So I'm looking at the other side. The template that you initially showed us, it has two sections. The first
yes,
section, which is the
mhm,
counter currency section, and the
yes,
base currency section. And that
yes,
base currency, you will now make some kind of conversion to
mm-hmm,
kind of
mm-hmm,
US and all. So
mm-hmm.
the remittance it's from that base, the base. When you now say it will be in euro, it was quite confusing since we know that the
Okay,
base here is US.
okay. But don't forget that this euro, right? First of all, they are selling, they are selling from Yilandwe to euro. Abi, do we get that part?
Yeah.
Are we clear on that part
Yes.
first?
Yes.
Europe is where the goods are being sold, right? Whether it is
Yes.
produced in US or whether it is produced in Yilandwe, the final destination of this good is Europe. Hold that one like that.
Okay. Okay.
Their home country, our group company is where? Is US. Let's hold that one. Yilando is now in between two of us. Now, normally, I could have decided to produce in US and sell in Europe, and Europe will remit to me in US. Hold that concept. But now, I don't want to produce in US. I want to produce in Yilandwe because if I produce in Yilandwe, Yilandwe would provide me some benefit that my cost will be reduced. So now, I'm not producing in US anymore. I'm producing in Yilandwe. If I'm producing in Yilandwe, it means that Yilandwe will produce the good and sell it themselves to Europe instead of me. Now, if Yilandwe is selling it to Europe, now let's look at the chain. It means that Europe will remit money to Yilandwe. Hold that one first. When Europe remits to Yilandwe, Yilandwe will now remit to me finally. Do we understand the chain now?
Okay.
Hope we're clear. Straightforward like that.
Yes. Yeah. Yeah.
Yilandwe
Let's
will now remit to me in US, which is the base country. Let's
country.
hold that
Okay.
like that. So now,
Okay.
that's why you will see that this selling price is in Europe. Is in Europe because why? The goods in going to Europe. What will as if I now want to do it? Normally, the first thing I will do is, in that foreign project template, we have the base and we have the foreign. The foreign here now, is Ilandwe. because that's where those goods are produced. Because Ilandwe is remitting to me in US, right? I'm the base US, which is down. For the up one is Ilandwe. It means that Ilandwe would have sold that goods to what? To Europe. Europe will remit to Ilandwe. Now, if Europe is remitting to Ilandwe, if I want to get my sales revenue, I can come here. Look at the screen. Look at my screen. Oh. You know that the sales revenue now will not be, because I'm dealing with Ilandwe now. This is Ilandwe's book. It means that the sales revenue will not be year zero. We're not doing any sales revenue. So it will be this selling price, which is in euro, right? Times
Yes.
the sales component unit. They are producing 150. Abi,
Yes.
I will now convert it to Ilandwe's currency. Do you
Okay.
understand?
Yeah.
Maybe we should just do it straight. Let's get Ilandwe's currency so that there won't be confusion. Or let me just put Ilandwe's currency here. Since Ilandwe's currency is like the bone of contention. So Ilandwe's currency, what is it? What's the exchange rate? Now, look at what they gave us. They gave us here forecast future rate based on expected inflation rate differential. You notice that in this question, they did not tell you to forecast this exchange rate. They have already given you. And why is it like that? They've seen that they've given you too much problem. So the examiner too is not wicked like that. When they notice that they've given you too much additional information, and they feel that do we now want to kill them? Let's just give them the forecast. But there are some questions that they won't give you the forecast exchange rate like this. You have to what? You have to search it out yourself and derive it using either that PPP or what, or IRP model that we explained earlier. So let's move on. And over time, we're going to prove it CSF. We're going to apply that thing we learned and see maybe it will work on this exchange rate. So let's move on. They said come in, please. All right. So they said Ilande's currency. Ilande to dollar is what? Is 120, 133, 142, 151. They said Ilande's to pounds is 165, 180, 190. Which one are we going to use? Is it Ilandwe to pounds for the sales we are going to use, or Ilandwe to dollar
For the sales,
for the selling price?
I think you landed to euro.
Thank you. Is zero. Yes.
No, you
Because
landed pounds. So I'm looking for pounds.
no, sorry. Euro that I said I was meant to say euro. I mistakenly said pounds. Apologies.
That's
So
what
I
I
said
was
is it? So I said is it euro or dollar? That's what I was meant to ask you.
looking.
Euro, right? So if it's zero, it means that this exchange rate will be what? Will be 165 here. 180.2, 190.2, 200.8. I initially did not solve that sales the way you wanted me to solve it immediately, because I wanted you to see these things. Sometimes, when someone solves it, you might not really get the picture of why this is this and why this is that. You might just be enjoying it as the person is solving it. That's why I intentionally told you that I'm not going to convert yet. I wanted you to watch something to see how, so that you won't make those errors. One is in euro, some is in dollar, some are in yen, right? So you know which one you are converting and how you are going to convert them properly. So now we've calculated that the sales component is 150, the sales price is 735. If I'm not converting it to to Ilandwe, I'll now multiply it by Ilandwe's rate, right? I will get this. Are we fine?
Yes.
So it means that this is sales revenue. Like this. I can come straight to my question and say sales revenue, so that I can be getting my points. Sales revenue. Pick this guy. Right. That one is done. Let's move on. You now told us that, if you remember, we did this we did this cost price. We did this cost price here where we had 280, right? And we said, okay, let's hold on this cost price first. Let's move on to the variable cost, because after sales revenue, we have variable cost. The variable cost, we already converted it to we've used the inflation rate. So now, but is in Yolanda's currency, so we're not converting. Abi, we're not going to convert that one now.
Yes.
So we're just going to take it straight to the.
It's,
You were saying something,
no, I said just take it straight. That's
so we just take it straight. So taking it straight, what do we need to do? We'll come here because this does the variable cost per. This per unit. So we have to the total variable cost. Total variable cost. What do? We come here. This multiplied by what? By 150, right? And we have this. When you have this, you go straight, you plug variable cost. That's that for that guy. Let's move on to the next point. We sorted this guy. We sorted this guy. So we have fixed costs. So for fixed costs, they said is in the currency. So we just bring down one. Fixed costs, right? Don't forget that they told us the fixed cost is a 4.6 million. So it's not that you can't. It's not a variable cost. So you are not multiplying it by the. You're just bringing it straight. So that's that for that. What next? What next? What next? What next? What next? So let's deal with the royalty fee. All right. So for royalty fee, so they say royalty fee is in dollar. If royalty fee is in dollar, that means we're going to convert dollar to yen, Abi,
yes.
to and what's the exchange rate? They told us here that the exchange rate is what is 120.1 in the first year. They said it is 133.7. It is 142.5. It is 151.9. So what do we do? We've gotten the exchange rate. We just multiply straight. So royalty fee. So we've done royalty fee. There's one we've not done. That contribution. The contribution of the one of 280.
The transfer price, right?
Yeah, that transfer price. We've not done. That guy. We've not done that guy. Well, even that transfer price, if okay, this one is supposed to be in Right. So we sorted this guy.
I think there is one assembling costs. That's the transfer price of it.
Yes. So the transfer price on, let's work on that one.
Transfer price.
So for the transfer price, where's that transfer price again? So that one, where's it? Okay, 280. So the transfer price. However, Imonico feels that it can negotiate 280, right? And they told us that all these costs, if you notice in that next paragraph, they said all these costs wherever incurred are expected to increase by that country annual what inflation rate, right? It means that even this transfer price of 280 will increase by USA inflation rate. Abi?
Wait, yes.
So what do? We bring USA inflation rate. What is USA's inflation rate? So you can see the variant of question I faced during my time. I told you that day I really struggled.
Was this your question?
This is the variant, something like this. It will not be exactly this, but of this kind of variant.
Okay.
It was a serious something. They
That's
said
pretty.
US, under exam condition, is a different thing. Especially when you are seeing the question for the first time.
Yes.
Under exam condition, it's as if all the thing will just leave your brain first. When you see this kind of long this thing, you don't even know where you want to start from. And you have to solve it within 40 minutes. Or 30 minutes. What am I saying? It's 30 minutes because out of 1 hour 20 minutes, you have like 30 or 40 minutes for calculation, and you have the rest for the analysis, because the analysis is the one that carries major mark. So all this calculation we're doing under exam time condition, you just have 30 minutes to do all these things. So you have 30 minutes to think and and pull this out. So, but let's move on. We thank God for life. So 1 plus this exchange rate, right? This one will be 288. This one will be this, right? If that is that, it means that, don't forget that this thing is in what? This thing is in dollar, right?
Okay.
It's in dollar. So it means that we're converting it to what? We're converting
So
it to yen,
you
to
know,
to yen. And dollar to yen, they already told us we have it here. Dollar to, this, we already saw one down.
mm,
Is this is the exchange rate, right? So
yes.
we can just come here, sort this guy out. ASAP. ASAP. Right. We sort this guy out. And we multiply it by the what? By the units, which is 150.
15.
You come up, you bring this guy here, you take it up. That's a transfer price. So that's this guy, which we've done. So how's it going? We move. We continue the hustle. Is there still more information? So we've dealt with that paragraph up to, so now the remaining one, now we've done royalty. I mean, this year redundancy, now that year redundancy is on the local currency, like we said. So that one does not concern Yilandwe, right? But there's something they told us. They made mention of tax allowable depreciation, if you remember, in that question.
Okay. Yes.
They said something about tax allowable that is 25% or so. Where's that place again? No.
Go down.
Ehen. Tax allowable
Yeah.
depreciation is available at 25% per year on the machinery on a straight line basis. I would have said I should create a column for, okay, let me just so that, because I'll still send this thing to you for. So normally if this tax allowable depreciation, TAD, the machinery is what? The machinery is
Is the
18 Abi.
yeah.
So it means that the tax liability division 25% is 4.5 Abi.
Yes.
Mm-hmm. So if it's 4.5, it means that I will apply 4.5 on all the years, right? So meaning that
Does it have
TAD,
does it have scrape or just 4-5 throughout?
they didn't tell us that it has scrap. It doesn't even have scrap because if it's 4.5, if it's 25% and the project is for 4 years, that means there's no scrap value. It's clear.
Yes.
Do you
Yes.
understand? It
Yes.
means that there's no scrap value. You know, the last time when I was teaching, at a point my voice was cracking. You remember that class? Now
Yes.
I've upgraded. I'm with Coke now, meaning that as I'm talking, I'm drinking Coke so that my voice will be very clear.
Calculations.
So that's the way forward. So you see that everything is going smooth. A very chilled Coke beside me. I talk for 15 minutes. I take small Coke. All
Okay.
right. So
That's
that's the
4-5.
so yeah.
And one other thing is this amounts in euros, in millions, and all.
Mm.
So you just need to be because
Yeah,
initially it was 150 you got, even though for the fact that there was some thousands in front. That one
yeah,
too is a mistake.
yeah.
Like this machinery now, you are doing
Mm.
it in thousands, whereas the sales revenue is in millions. You could see
I'm
what
going to
I'm
change
saying.
it. I'm going to change it now.
Okay.
You know what? I can do it. I can even because this thing now, currently now they're in the absolute, right? I
Yes.
mean, they are in thousands actually at this moment. In this, they're actually thousands. They're actually in thousands, not millions. They're in thousands. It's only this thing that is in it's only the land I'm building that is in
Millions.
millions. So I can convert this ones to let's just convert it straight safe. Just convert it. So oh, oh you you know the TADs. I picked this guy for that
Okay.
CAD. You remember, right? So
Yes.
there's no So we'll just instead of
And these functions, they are not there in the ACCA platform.
you
This
know you know it's- you know it's limited now. This is a platform. This is limited. You can't be doing. Though you can apply some are applicable. Some are not. I know that it's not 100% right, but at least there are some. So that's why the best thing is you need to keep on practicing so that you will know. You have to be using the platform regularly. Don't use Excel when you are practicing. Use the platform one itself, the blank platform one, so that you'll be able to familiarize yourself with what is there and what is not there. Do you understand?
yes.
That's the best way. All right, so
Maybe
let's
as
move.
go on, I'll just ask you a question.
All right,
There's a question I wanted to ask.
all right. So I think that's that for this part. Except if they want to wound us.
This is the
That's what I.
question. The
What did you
what you
say?
just the what you just did now is the
Mm.
question I wanted to ask. In the platform, there's
Yeah.
nothing like a direct line like this that goes through. Do you understand what I'm saying?
When you say a direct line.
Like this underline that
Okay,
goes
there
through.
is yes, no, there is no.
Okay.
So me, what I used to do during my own time, right?
Looked for it, I didn't see it.
No, there is no. Do you know what me I normally do during my time? I bold. Do you understand? So let's say I get cash flow now, right?
Hmm.
That's what me I do. I just bold it. I don't have time to do all those ones, so I just bold straight. Except if you want to be doing it individually. Do you understand?
Okay.
But what me I just do is I bold straight. So that bold will show that okay, this is like a demarcated a key point that they need to learn, they need to note. So we move to the taxable profit, and we get this, we get this, right? We've gotten this now. Now we can apply our what? We can apply our tax. We can apply our tax. But don't forget something. They said something. if you remember in that tax part, right? They said, let's read that
Taxes
tax.
2 years.
They said, um,
The
Monico,
tax charge in the first year and second year.
yes, that's the one I'm looking for. Which paragraph is that?
Just go up.
That should go up. Okay. Aisha is up. Okay, So they said an opportunity to carry forward taxes, losses, and write them off against future profits made what after 2 years. It means that this guy, so this tax loss carried forward, taxable loss, not tax loss, taxable loss carried forward. So it means that this one I can carry forward after 2 years, Abi. This guy.
Yes.
Uh-huh. So I'll bring it here. So I will now come here, make this one, create a line for it. So it means that my taxable profits will be that's what my taxable profit would be now. So I'll now apply what? I'll apply tax. And what's the tax? What they tell us the tax is? Can you
Mm-hmm.
search that out? In your landway, what's the landway's tax?
Um,
Yeah, figure.
25.
Eh? Are you sure it's 25? I know one is 25. I know one
No,
is
you
25.
have a beg.
Can you go up?
In money is 20%.
No, go up. See my screen.
Okay, up. Okay.
I can see 40%.
40%.
Yeah,
Ah,
so
too much.
it's very high now.
40%.
That's what the former government. It's the former government now. The former government wanted to kill them now.
Okay.
So let's move on. So 40%. So it means that if you don't remember, if they said in the first 2 years, right? There's a concession, Abi. They
Yeah,
won't be paying
0.
tax. So it's from this year two they'll be paying tax, right? So I can lock this guy C18 and does drag. So when we do that one, after that, what do we normally do to get the cash flow?
You add back depreciation.
Thank you very much. You add back tax depreciation. So I come here, add back TAD. So the beauty about this kind of question is that when you solved, when you've cleared those issues that we cleared down, right? You go
Oh,
on a free flow. That's the major part. That's the most confusing part, that under exam tension, one might be destabilized. But if you are calm and you are taking it step by step, don't rush yourself too much. Don't be too even while you're trying to work with speed, there's something called accuracy. You must not forget that accuracy is very key. Ensure that you're not making errors.
okay.
Yeah. So this is cash flow afterwards, after tax. They told us something about the working capital, if you remember. Remember the working capital? They said it will be growing by something. By the working capital will need to be increased annually at the start of each year of the next 3 years by Yilande's inflation what? Yilande's inflation rate. The question is, what is Yilande's inflation rate?
Is the one up.
Hmm?
The one
Let's,
up.
no, give me figure now. It's figure me I need to.
Uh,
What's Yilande inflation rate?
in
Okay,
my
that one up. Okay, you're right. That's that 22%, Abi, and all
yeah.
those 14 and all those things. Yes. All right. So we can come down and quickly work on that one then. So we can just come down here.
Work it directly on the listen.
Okay, we should just do it directly, Abi.
Yes.
Okay, so that means this 96 multiplied
Uh,
by 1 plus. I think we put it down somewhere. There's a place, this guy, Abi.
okay, yes.
Uh-huh. So if it's this guy, right? So it will be this minus this guy. Abi now, the normal way we know it.
Okay.
Am I wrong?
Can we just do it work it to be sure?
You know that told
Good.
me to do it this way. That I humbled myself. I wanted to do a long course for you. You said I should do direct. Sure, you understand? I said, okay, oh, my madam knows it better than me. So let
Uh,
me
uh,
let me let me follow.
mm,
Okay, so let's do a working. So they said it's going to grow by the inflation rate. And we know that this is Yilande's inflation rate, this guy here,
yes.
the way we saw it up, right? This guy. So it means that this 96 in year two, year one rather, because they said the working capital will be needed immediately at year zero. So it means that it will grow by this. This is how it will grow, right?
Funny enough, you were actually correct though.
I was correct now. I was not wrong. I know what I was doing. Oh, you didn't trust me, Abby.
No,
So
no,
it means
I
that
didn't I didn't trust your Excel that was not updated.
all right. So it means that every year, right? I'll be
Plus
needing this additional, right?
so yes,
I'll be needing this additional. They now said something at year four, we're going to what? We're going to get it back. Where is it? Where's that
recoup.
part? Oh, we're going to recoup it. I know they said it.
It's down.
Okay. You even know the question that means now, sef. So it's
Yes.
here. They said by Ilanda inflation, and it's assumed that this will be released at the end of the what of the project what life. So it means that at the end of year four, this 9 6 that I gave in year zero plus this first year addition plus this second year addition plus this guy addition, I'm going to recoup it here. Abi?
Yes.
So I can bring everything now to the. So I just come here, bring this guy here, and I do what? I drag. Shike now. All right. So what next? I think that's all. At least for this guy here. Oh, for this guy here, I don't think there's anything again. Any other thing that we have, I think it's relating to the second guy. All other things are additional information, except this redundancy cost, right? And the cost of capital. So I think those are the only things that is remaining. Other things we've done justice to it. And don't also forget the transfer pricing. It's coming back. That 280 transfer pricing is coming back as an income to the you get
Yes.
to the home country. So we still have transfer pricing, we have redundancy, and any other thing that we notice as we go on. All right. So we can bring this guy to a close here by summing. What's this? All right. So I think that's fine. So I can use this double and bottom, right? I can even bold it if I want to, because that's the cash flow. That's the cash flow. Don't forget that this cash flow is in this guy, right? Abi?
Yes.
So please don't forget. So now, based on our quarter view, our templates, we now need to calculate for the base country, Abi, which is the home country that all remittances are coming into. Abi? And that currency is what? Is it dollar, euro, or what currency is that?
So that would be in dollars.
Thank you.
Okay.
So dollar. So we come here. Let me create small lines. Right now, we come to the home base. So this one now will be all amounts in what? In dollar, because now this one we're reporting it in dollar. So if it's in dollar, what's the first thing? Based on our template, we said we are going to what? So we said we are going to what? Exchange rate, Abi? We're bringing in exchange rate first. So now, what's the exchange rate? What's the exchange rate in YR to dollar? Please, can you help me with that?
The exchange rate for
The exchange rate now,
Y.
if I convert into dollar from the yen, na be the waiting, the land based currency. What's the exchange rate? Is in the question now.
Is it the one for 120.1 and 1337?
Yes, ma'am.
Okay.
That's it.
Okay. You
That's
just
it.
divide.
Yes, I'll just divide. I'm coming. There's something I'm looking for. Mm, mm. Okay. There's something I want to show you, right? Though this was not part of the question, but I just want to show you for your when you see a different variant. So you can see they've given us the Y hat to dollar, right? Which is 120, 133. Abi?
Yes.
So we bring it here. 133.7, 142.5, 151.9. But with what I explained to you, right? I told you that normally in questions, they might not give you all these things, right? You have to derive it yourself. Abi
Yes.
now, you remember. Now, let's now assume that they didn't give us these things and we have to derive it from this question. How would we have done it? Very
Um,
simple. Oh, yeah, explain.
well, I
What will
think
I do?
the spot rate is 101.4.
Thank you very much.
You must
101. If portrait is
point
101.4, what will I do?
you
Yeah, pull me
multiply
through.
equals to
Okay.
the 1 times the Yolande rate interest sorry inflation rate divided
You
by
learn
that's 1.22%,
2 2.
22%. Yolande inflation rate, the one up
Okay.
divided by this one
Okay.
divided by
Divided by what?
1 point the US 1.03.
Thank you very much. So I'd have done this multiplied by plus 22%, right?
Mm.
Divided by 1 plus 1 plus 3%, right? And I'll bracket everything. And this approach, is it interest rate parity or purchasing power parity?
It's purchasing power,
Thank you very much. Because you are using what?
inflation. Right?
Thank you. So you can see that this is 120.1, right?
Yes.
And that's how I would have applied it for the rest, and you'd have gotten this exchange rate as they have it there. So thank you for that. So there are some questions that you might not have the what, they might not give you the forecast. You are the one to derive it yourself. So we've demonstrated that now. So meaning that there's no need for us to solve a question with that variant because you already know it. That's the assumption. Thank you very much for making my work easy. All right. So that's
Can
the
we, can we
but
spot rate under that year zero?
yes, we put the spot rate 100% because we need it for the what have you, the initial investment. You know those ones are done as spot,
Mm.
so we need it. So what do? We go to the what, to the remittable what, remittable amount or remittable flow, whichever way you call it. So remittable flow will be divided. Please don't think that everything is divided. Oh. Everything is divided. Everything is divided. Oh. Understand the base currency. Understand the variable currency. Oh. Don't think that everything is divide. Oh. There's some questions. There's a way they will twist it that you is multiply. You will multiply. You hope you know.
Yes.
So please don't make that mistake. Oh. It's not everything that is divided. Oh. Thank you very
Mm.
much. It's because we're solving this question that is divided. Oh. All right. So that's this for this. What next? We now move to the contribution. That contribution that we left. I remember, don't forget, they told us that before what were they doing before in that contribution? You know, I said it before that they were getting a contribution of what? They're getting a contribution of 40. Abby?
Yes.
They're getting a contribution of 40. If they were getting a contribution of 40, or let me do it this way for you. Originally, the stuff was 200, and we understand that the cost was 160. Abby?
Yes.
Right? Made them get a contribution of 40, Abby. Now they now
Yes.
said, they now told us that what? They now told us that what they tell us? They told us that this thing, they they increase it from 200 to what? To 280, Abby.
Right. Yeah.
So meaning that that's a plus 80. Am I right?
Yes.
So it means that the new contribution is now what? 120. And thank God is in dollar. So we're not converting what? We're not converting any anything. But don't forget that for everything you are doing, they told us in that contribution, in that part of contribution, they said everything is affected by the country's what? Inflation rate. Do you remember?
Yes.
So, and the inflation rate in USA is what? If you've
Yes.
if you've not forgotten, 3%, Abby.
Mm.
Thank you. So while it is 3%, don't also forget that we have to multiply it by the number of goods, right? Because this
Yes.
contribution is per. So this component unit is 150. So this is what we have. This is the contribution, right? And the contribution is a what? Is an addition to us. It's not a cost because it's an extra flow for us. So which one do I lock now? No, I can't lock anything because everything will grow. Everything will grow. This one will grow like this one. This is this. This is this. If I'm not mistaken, yes. No, it can't be now. Hold on. Because this one is B29 times the inflation rate. So if we're going to do it, because their units are not the same, it means that this guy will be, is supposed to be, hold on. Because the exchange is growing by the exchange rate, right? It's growing by the annual inflation rate. It's not growing by the same number of units. It means that it's going to be this 120, but growing at raised to power 2, right? Do you
Yes.
understand?
Mm.
Uh-huh.
Why don't you reference the first one?
Don't worry, I'll reference it. So this is it. Because it's growing at the inflation rate. One twenty times this raised to power raised to power 1. So 120 times 3. Yeah. 3E45 and by the exchange rate 1 by base 1. So if it grows, it will grow again by this guy raised to power 2 times what? Times 2. So that's supposed to be the expectation, if I'm not mistaken. Um all right, let's move on. Mm, 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 mm. Mm, 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 mm. Hmm. There's a twist somewhere. Come and see something. Because I wanted to confirm something. If you move to this, can you see I'm on this paragraph of the Ilando's this thing is 15,960 per component unit. Can you see that part?
Which part?
Ilando's 15,960 per component unit. This part. See the beginning where I am here. Can you see it?
Yes.
If you notice, they said the current annual fixed cost of the assembly plants are 4.6 million. All these costs, wherever incurred, all these costs are expected to increase by that country's annual inflation every year from year 1 to onward. What does this suggest to us? You know that inflation is only on cost,
Yes.
meaning that this contribution will not be affected by inflation. Do you understand?
No.
You don't understand. Don't forget that in a landway, that this transfer cost, this transfer price, right? You know, this
Yes.
transfer price is related to this contribution that we have here.
Yes.
What they are saying is that this, you know, if you notice this transfer price, we grew it by the annual inflation rate. Do you remember?
Yes.
It means that every inflation rate that we did was done based on only cost. They said all these costs in Yilando's book is cost is growing by inflation, but
Mm.
in the base country where they are getting that revenue, they did not tell us that revenue is growing by inflation rate. Do you understand?
Yes.
So meaning that we're not supposed to grow this. We're not supposed to grow this guy by maybe by year 2, year 3, year 4. It's just supposed to be constant.
Okay.
It's just what it's supposed to be. That's all. And year 3 also, we'll log this guy, and this is it. All right. So let's move on. So what next? What's remaining? I think there's one we've not dealt with that is hanging in my head.
What about that royalty fees? Are we going to
Thank
do
you.
it?
Thank you very much. Royalty fee, yes. We have a royalty fee. And that royalty fee, we said it was what? We said, it was first in dollar before we converted to,
So it's 36.
you get.
Mm,
So royalty 36. So we just bring it, we don't waste time. So 36. What again? Oh, what again? Oh,
that's tax.
yeah. Thank you. And what's the tax rate?
20%.
So tax. So they told us that there's a double there's a double treaty agreement now, Abby, within the two
What, do-
countries. So it means you're saying something.
what does it mean? Sorry.
Double treaty means that if there's an arrangement, it means that if you've paid in that country, it might not necessarily mean to pay in our country again. Do you get?
Yeah.
Or sometimes, if you notice, they paid 40% in Ilandwe. If you remember that you said the tax rate was very high. They paid 40, right? And in the home country, the tax rate is 20. It means that they've paid very high in Ilandwe. So in the home country, they will not need to tax them anymore. What they will just tax them is only on this royalty and contribution. Do you understand? Because this one was generated in the home country. Do you get?
Okay.
But that other cash flow, the remittable flow, this one, it has been taxed already in Yilandwe at 40%. So they won't have to tax them again. They will only tax them on these two new guys that came into the country that was not taxed in Yilandwe. Do you get?
Okay.
This contribution and royalty were not taxed in Landway because they were expenses. I know they were expenses. They will reduce the taxable amount in Landway, right? But for the fact that you reduce your tax in Landway, you are still going to come and suffer it in home because it's here that you enjoy the benefits. Do you understand?
Yes, I do.
Uh-huh. But let's say, for instance, now in Yilandwe's tax rate was 20%, right? And home country was 40%. If they tax you 20% in Yilandwe, you see this remittable amount. If they have taxed you 20% in Yilandwe, this remittable flow. If they tax you 20% in Yilandwe, if you come to Nigeria, we are going to tax you the remaining 20%. Because why?
Okay.
Our own tax rate is 40, but you've suffered 20% in Inland Way. So we'll charge you the remaining extra 20. When we charge you the remaining extra 20, you now see this contribution and royalty will now tax you 40%. Do you understand?
Yeah.
Thank you very much. So that's the way double treaty. But because we have already charged you 40 in Yilandwe has charged you 40, and our own tax rate is low at 20, there is no point charging you because, in fact, in our own eyes, you have been overcharged in the foreign this thing compared to what we would have charged you naturally.
Oh, sorry.
So
I need to charge my laptop
uh,
and take a break.
okay, so I'm rounding up now. Just give me 2 minutes. I'm almost done. Oh, please. Oh. Let me just round up
Okay.
so that I'm done
My-
and there's nothing remaining. We've done. So let me take the tax. Eh? Ah, Z, you said you want to take a break. What happened?
My laptop is almost 5%. I've been
Oh,
managing.
okay, okay, all right. Okay, so let's just quickly, please, because I don't want to come back to this again. So this is
Okay.
this is the tax. Mm, let me lock. Let me lock
So,
this cell. Right. So this is the tax, and the next one is what? Is just the cash flows, right? To be discounted. So what's now the cash flow? The cash flow now will now be The cash flow will be this. Right. If the cash flow is this, please quickly help me with this thing, with the discount rate. What's the discount rate we are
And
going to
that's what
use?
works. We have to discount rate. That's
Uh,
another question. But
what's
this
the
man,
statement?
we
Okay,
are
what's the statement?
project specific discount rate is 12.
Mm,
Then the COC, the Imoni normally uses 9 to assess the project. However, the finance director suggests that Imoni uses project specific discounting. So what my question is, what's the difference? And in since we are investing in a new
mm, mm,
like
mm,
a new country,
mm.
which one is ideal? Just in case I want to ask a question, which one is ideal, and what is my explanation for which
Z,
one I'm
Z. First of all,
mm,
normally, if not that this thing, if it was a physical class, the side eyes I will give you, the
mm,
side eyes I will give you, because normally I expect you to know this, right? 100%. And why? What do we say? Don't forget that when you're investing in a new project, right? And let's say
mm,
the project is not in your own country or anything, are you not first
mm.
of all, will your business risks not change automatically?
It will,
If your business risks changes, are you still going to use your current work?
but we are using work based on your capital structure.
You are using work based on your capital structure, subject
Yeah,
to your business and financial risk. First of all, do you understand? Your
this
financial,
is this one is this information is new. I need to jot it down.
your your project specific work is based on your business and financial structure, your financial risk, business risks and financial risks. Financial risks talks about if we are changing our capital structure, maybe we're getting more debt or we're getting more loan. Do you understand that one? Right
This
now,
information you're giving me is new. You are not
uh,
supposed to give me side because it's new.
okay, sorry, sorry that is new. Sorry that is new. I'm sorry. Okay, so if you're in this question, they did not tell us the financial structure is changing, right? Which you accept, but automatically the business risk is going to change.
Yes. Okay.
Automatically, you're already exposed. So your business risk and if your business risk is going to change, that means you are going to calculate a project specific work for this project,
Okay.
right? So meaning
Okay.
that is the 12% you are going to use. And don't forget, if they ask you in a question, okay, what are the assumption made? I've already given you an expo. When they, when you're talking
Yeah.
about assumption, you are telling them, okay, we made use of the what of the project specific work because why the business risk is changing. Do you understand?
Yes. Let me even
The
write it.
the
So,
lecturer will know that it was Shegun that took you that class on foreign operations.
so um, the financial risk, the business risk is of high priority than the financial risk.
I never said it's of high priority. Both of them
No,
work hand in hand. Don't say
it's at
I didn't say priority. Oh. I already told you that if one is changing, either one is
pri-
changing, whether your business or normally for work we have business risks, we have financial risks. Abi,
yeah.
if one is changing, automatically anyone that is changing, it automatically means that your work automatically will change. Meaning that you have to restrict your work to the project specific work based on the current condition, either from a business perspective, business risk perspective, or a financial risk perspective. Do you understand?
Mm.
Yeah. Maybe that's where we do all those gearing and non-gearing and asset beta equity, all those things. That's the rationale for all those things now. All right. So I just do my normal way now. The way we know it. What is this one?
So
I did not lock. I'm with you,
sorry,
ma.
I'm back.
Hmm.
Please, can you just like so that I'm actually typing what you are saying, especially with respect to that project specifically. So you are
Okay.
saying that the project specific risk.
Hmm. Okay.
Oh my God, it's not working again.
Your keyboard is not working.
Mm.
Sorry.
My keyboard is not working.
And thus
Yes.
I can chat you that thing. I can chat you what I told you. You understand? I can chat you when I'm done. Don't stress
I
yourself. I can chat you. I can chat you on those. I can chat you. So we've gotten the present value, right? We get it. Okay, now no, the present value now. So you know the normal way now. The present value is the multiplication now. So this multiplied by this, right? This we have this here. And what is the what's the NPV?
MPs.
This is our what? This is our
Okay.
NPV. The NPV is it in dollar or is it in naira or is it in kobo?
This is a Kobo.
Is it you caught me on that one. You try.
In dollar.
You try. All right. So let's do that. Let's do that. Let's do that. Let's do that. So we have here um parara para pe bidi 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 do 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 I'm just checking. I'm checking something, please. Hold on. You know we've cooked one bean somewhere. No, I don't think we didn't cook any beans. We didn't cook any beans. Is our taxable profit for 360 for 2140. I think we're fine. I think we're fine. Fine. Is our tax loss. How much you were saying something?
When is the next class? Sorry. I need to repair this my laptop.
The next class. You know, normally we're supposed to do this thing. And there's one information I wanted to give you. Don't forget
Okay.
that you know that tax loss, that taxable loss, right? You know, we use it to offset our taxable profit. You remember.
Yes.
Normally, when you use it to offset your taxable profit, we're supposed to add it back.
Oh.
Yeah. But we didn't do that. So let's bring it back. Add back tax loss. We're supposed to add it back.
Just like depreciation, right?
Yes. Just like depreciation. So I think we should be fine now. I think we should be fine, yeah. So I think we're fine now. So this is our NPV. That's the thing. So this is our NPV. So now from this is the amount, is it what are they calling it? Is it viable? Is it positive? Should we embark on it? I leave it to you. What do you think?
Yes, we should.
Thank you. So this is a question. I will share this with you, right? Hot, like that. I'll share this with you so that you can use it on your personal. Also, there were some written parts here, but because you are going, so there's no point. I wanted to. So this question, I believe you can answer this one yourself. So because you can see that financial this thing, what we just did now is just what? It's just 20 marks. So you see out of 50 marks. So
Yes.
please don't go and spend all your 1.5 hour on solving 20 marks question. No. I've told you, if you have 1 hour, 20 minutes for number one, please and please use only 40 minutes to solve the calculation part. Anywhere your biro stop there. That's my best advice for you. As you are solving, if you don't finish, and it's already 40 minutes, stop whatever you are doing on calculation, go and start getting points from the written part. It's a report, it's like a memo. You have your date, from, to, and then subject. You now start putting all those reports. Do you understand? So if you go and do your appendix, the calculation, and by 20 minutes, by 40 minutes, you are still calculating, stop. That's, say, I just hear my voice in the exam, even if you are tempted to continue, that I say you should stop. I will be the angel talking to you that day. Don't stop immediately and go and quickly write all those cheap ones that you can write without, because there are some that you can quickly eat that is not related to what you are, to that calculation part. Do you understand?
Yes.
That, so all those ones, quickly go and get all those ones. If there is now time, go and finish the calculation and bring it back to the report. That is my best advice for you. That is how me I've been doing my thing, and others have been passing. It's not about
Okay.
what you know, it's about how smart you are in ACCA. It's
All
smart
right.
people that pass ACCA. It's not brilliant people most times.
Okay,
Yeah.
sir. Thank you very much.
So please, why are you rushing? You are not going anywhere, because I remember in those times you
But
told me that I'm going to
is
I'm going to take your time. see see this number here. They said discuss the possible benefits. You can go and do that one now. Setting up its own assembly plant. That one is simple. Evaluate the financial acceptability. That's what we've done now. Discuss the assumption. You know those assumptions the way we normally do it now. The sales revenue, this thing may not be forecast, may not be correct. Sensitivity analysis and scenario analysis is needed to ensure that it is, you understand all those things that we normally do. We use the project specific work because of the change in business risks, or maybe there can even be some financial risks that's changed, or financial structure due to the new investments. So you see all those things that related to all those assumptions that was made. Then I say provide a reasonable recommendation. You know the recommendation now. We can go ahead, because the investment is what is positive. Abi,
yes.
and please write it very well, communicate very well, analyze it very well, so that you can get your 50 marks. I pray God will help you in Jesus' name.
Um,
Amen. All right.
thank
So let's meet this week for option pricing, right?
please,
It might be
please
it might be
can,
Wednesday or Thursday.
can we prioritize dividend, please?
Okay. Okay, okay, option pricing, Abi. There's no
No,
stress in that one, Abi.
I don't know it, oh, but let's prioritize dividend.
Okay, so let's work with dividend capacity, either Wednesday or Thursday.
Thank
Let's
you
work
very
with
much.
dividend. All right. Have a wonderful day. Yeah.
Same here.
Was today productive?
Very productive.
All right. Yeah.
I'm going to the website now to drop review.
All right. Now, so we'll meet during the week, and at least I'm 100% sure that this week, we are going to finish dividend capacity and option pricing. You see, from next week, be ready for 15 marks question. That's only what I'm dealing with. I'm not going to all those small 15 marks, so that your head will be boiling like this for my part. So all right, now take care. Have a wonderful night. Yeah.
Bye bye.
All right. Thank you.